Hello and welcome to this week's episode of Investor Intelligence, brought to you by the team at the Property Mentors. It's your weekly podcast for all things investment. My name is Phoebe Sikowski-Wallace. As always, I'm your host / investing beginner, and with me again is Luke Harris, our investment expert. Hello, Luke. How are you going?
G'day, Phoebe. How are you? February already.
I know. Can you believe it?
It's crazy.
So, coming up on today's show, we are talking about positive and negative gearing. And I have one goal for this, and that is to actually understand, or at least have a basic understanding of what they actually are by the end of this episode. Are you up for that challenge, Luke?
Absolutely. It's always a hot topic in property.
Yes, I hear it can get a bit heated sometimes between investors.
Yeah, I think everyone's got an opinion on it. But obviously, there's a lot more to choosing a property than just choosing whether it's negatively geared or positively geared.
So, Luke, you've written several articles on this topic, which people can find on our blog, and there's also a chapter in Property Fit about it. So I've read both, and the more I read up on it, the more the topic just seems to get more and more layered. So let's try and keep it very simple and very beginner level today. So, Luke, to start off, I challenge you to give me your most layman's terms, simple, beginner-level definition of gearing.
Of gearing. Okay, well, to keep it relatively high level and simple today, it's quite a complex topic and we can drill down very deep on it. But essentially, gearing is a tax treatment. And so when people are out there talking about negatively geared property or positively geared property, and sitting in one camp or the other saying you should only do this or you should only do that or you should never do this or never do that, they're talking about the tax treatment of the property. The gearing of a property is a tax treatment. So be very clear that the properties themselves aren't necessarily negative or positive. It's the treatment of the tax on that property.
Oh, okay. Yeah, so it's not the actual property itself, it's all to do with the tax. Gotcha.
So you can't drive down the street and go, that's positively geared, that's negatively geared, and pick out your property based on the gearing just by looking at the property.
Okay, so it's a lot to do with the ownership and I guess the owner's circumstances as well?
100%. Yeah, it's different from, say, for example, if you bought a property and I bought the same property, or an identical property next door, because we can't buy the same property.
No.
We would look at the numbers side by side, and our situations are different. And so when we're looking at income and expenses and tax situation, we've got different situations, and most people are going to find their tax situations different to the next person. And whilst the property figures might be the same, the rental income and the depreciation, our own individual circumstances will dictate how the tax is treated on that property.
Interesting. Okay. So what is an example? We'll start off with positive. What is an example of a positive geared property?
An example of a positive geared property in a raw sense is that the property brings in more income than the expenses on the property. So often you'll find that a property that provides a positive income is typically in a regional area or an area that's essentially a higher risk to it. And it's not always the case, but a lot of the areas that are known to have properties like that are in regional areas. And a perfect example of that was in Western Australia during the mining boom. And we're talking about the big mining boom, not the long-term mining boom in WA, but in the mid-2000s, properties in regional Western Australia in the mining areas were renting for $2,000 a week, and they were selling for $1 million. So the income was far above what the mortgage payments were on that particular property. But that's not a long-term thing. Those properties are now worth $400,000, and they're lucky to get $400 or $500 a week for those properties. So, I guess the way to look at your property portfolio is to make sure that the property fits in with the long-term plan, and that we're not just looking at a property in isolation. We're looking at how the property and all of the figures connected to that property fit into your overall financial situation.
Can you just quickly define what you mean by high risk?
Well, higher risk could be in an area like I mentioned, in the Pilbara, for example, in Western Australia during 2000s. A lot of people were quite comfortable to go and pay $1 million for a property because they thought, well, I'm getting $2,000 a week rent. So in their view, it was a low risk property. It became high risk when the mining boom ended and everybody left the towns and those properties dropped in value. So gotcha. I guess the higher risk comes from being in an area that may not be the best for long-term investing, in that it doesn't have the best investment fundamentals. So whenever you're looking at investing, you need to have the fundamentals there first and foremost before you even review the numbers. If the fundamentals aren't there, it's got no reason to maintain the value that it currently is or to grow in value. And when we're talking about fundamentals, we're talking about supply and demand fundamentals. We're talking about infrastructure, schools and shops and hospitals, freeways, public transport, all of the things that people need and they want when they're renting a property or living in a property. So essentially that underpins the value of a property. And if those things aren't there and people are only buying in that town because of a one-off mining boom, with the hope that the high rents are going to be there forever, then I consider that to be a higher risk property.
Okay, cool. Okay, so going back, so positively geared is when the rental income from that property is greater than the outgoing cash costs, which we will cover in a second. I'm guessing negative is the opposite of that, but can you just explain what an example of a negatively geared property would be?
So a negatively geared situation would be where the property is costing you money out of your pocket every single week. And of course, there's a couple of ways. And as I said, we're not going to go too deep into this today, but obviously you've got the property in isolation, you've got the property income and expenses, and then you've got your own tax situation linked in with that. So if you're just looking at the property on its own, you say, well, the mortgage is $500 a week and I'm getting $300 a week rent. Right, so there's $200 a week difference there. Plus I've got rates and insurance and repairs and maintenance and other things. So that property on its own would be a negatively geared property because it's of course costing me money every week. Whereas the other way around for a positively geared property, let's say I was getting $500 a week rent and the mortgage was only $300. Then I've got $200 a week surplus income coming through. Of course, I still need to pay my council rates and insurances and other things out of that, but it's in isolation in the property on its own. It's positively geared as such. But then what happens is your tax accountant doesn't just look at the property. You're obviously the owner of that property and your tax situation comes into play as well. Mm-hmm. So some people's situations are going to be different. If you've got a lower income, then that will change your tax position. If you're on a higher income, again, your tax situation is different. And how those properties affect your tax situation will be different for everybody.
So rental income is obviously the money you make from your tenants. The tenants are paying you. But talk to me a little bit more about what these outgoing cash costs look like.
So a typical property will have either a council rates for every property. Unfortunately, we can't avoid those. Councils little mini governments that like to dictate all of the local government rules, the local area rules. And of course, you can't get away from those. You've usually got water rates and other costs that are that need to be paid. But then, of course, you need your landlord's insurance. They're the three big ones that you would have to cover. And then, of course, property management fees are a given. You'd need somebody to professionally manage the property. And then, of course, some properties are going to need repairs and maintenance at all different levels. Some need a lot of maintenance, some need very little. We've covered that in our previous podcast, talking about new and established property as well, and the differences in maintenance costs there. So all of those things really get bundled together in a typical outgoing situation. Sometimes you've got body corporate and owners corporation fees to pay if you're in an apartment, for example, or in a body corporate type situation. And some properties have got pools and gyms and all sorts of things, so there can be extra levies applied there. And of course, if you're in a group housing situation, I've got a townhouse on the beach in Melbourne, and there's I think 20 or so townhouses in the complex. It was built in the year 2000, and of course that's a little while ago now, and the drainage and things like that need doing in the future. So the the owner's corporation has put together a budget to say, hey, we've got to pull up the driveways and replace the drainage because there's some cracks and various other things. And that doesn't need to be done for at least another 5 years, but they're planning for it now. And obviously, by the time that's done, we'll be getting close to 25 or 30 years lifespan out of that particular infrastructure in the development. And so they've put a slush fund together to start contributing towards that now, so that $250,000, $300,000 that needs to be spent pulling up all the drainage and the driveway doesn't get, we don't have the money to do that if we don't plan for it. So they've put plans in place to raise a little bit of money over a long period of time from the owners to prepare for those bigger infrastructure upgrades. And that's a smart way of doing it. A lot of owners will, if they've got their own standalone property, won't put money aside for big repairs like that. So sometimes it's a forced saving when a body corporate or an owner's corporation plans for those type of unexpected expenses that are expected to a certain extent.
Okay. So you touched on insurance just then. Whether you're buying a negatively or a positively geared property, what are some of the insurances that you have to consider?
So there's two types of insurances that most investors will take on. One is your building insurance, which covers the actual building and the construction of that building itself. Of course, if there's a flood or a cyclone and the building falls over, well, you'd want your insurance company to rebuild it for you. And that's in a very general sense, of course. And then the landlord insurance is the other one that you should be taking out. And landlord cover covers everything related to the tenant. Okay, so that means loss of rent, tenant default, and also malicious damage by the tenant. So if the tenant decides to move in, not pay rent, pull out your kitchen and put it on eBay, then there's insurance for that. And believe me, those sort of circumstances have happened. They don't happen a huge amount, and that's why insurance premiums are relatively affordable for most areas. But definitely insurance is something that you should be paying for. Again, I treat my investing like a business and make business-like decisions. So all of my figures go into the Augur report. We've got a website called augurinvestor.com.au that we go to, and we go on Augur, we punch in all of the figures for the property, we punch in all of the figures for the actual investor, and the investor themselves will actually come out with a figure at the end showing all of their income, all of their expenses, and it will spit out a figure at the end whether that's going to produce a negative outcome or a positive outcome.
Interesting. And can properties switch from positive to negative back to positive? Can it switch back and forth? Yeah.
Absolutely. Now, if you go to the ATO website, you can look at the different tax brackets. And obviously, sometimes you might be in between tax brackets, or you might be at the borderline of getting into the next tax bracket. So what happens is, if, let's say, for example, you're on $75,000 a year and you've got $20,000 a year rent coming in, when your tax accountant does your tax return, they're going to look at your $75,000 and they're going to add the $20,000 worth of rent on top of your income. Now, what that does is that pushes up your income to $95,000, and that might put you into the next tax bracket. But at the same time, whilst they're adding your income together, they're also taking your deductions away from that. So what they're doing is they're taking off that $95,000, they're taking off your interest expense. They're taking off your landlord's insurance and your council rates. They're taking off your property management fees. And they're taking off all of the other expenses related to you doing business as a property investor. And so what you might find is that over and above all of these expenses that you've got as an investor, you may also have depreciation benefits, which is an on-paper loss. Right? And as I said, we're not going to go too far into that today, but if you've got an on-paper loss, your actual income may actually reduce from your original $75,000 down to $65,000. You actually, a lot of the times I'm working with our members, we actually find that a lot of our members, their income actually drops, reducing them into a lower tax bracket. So there's opportunities out there to save tax. And again, it comes down to the actual property. So this is why the property itself is not positively geared or negatively geared. It's the tax treatment of that property, and it's going to be different for every investor.
So by definition alone, positive gearing sounds like the obvious choice of the two. So should people be chasing positively geared properties?
Well, again, I think people looking for positively geared properties have sort of been fed a little bit of misinformation over the years. And when I was growing up and buying property, I had this thought that the whole concept of chasing positively geared properties was the way to build wealth. And there was a lot of gurus out there that said, well, you should only buy positively geared properties. Why would you buy properties that lose money every year? But often what you find is that if you've got an area that's got a higher rent, as opposed to the areas that have a more average rent in the marketplace. And this is a generalization. I want to be clear about that. There's always going to be
general
the exception
information
to the
only
rule.
today, yes.
But I think that some of the areas that just have a normal steady rent that's in a low vacancy area, you'll find that you're going to get often a better capital growth rate. So we're looking at investing for capital growth and for cash flow. And a lot of investors that talk about positively gearing, they're only looking at the cash flow component. And sometimes what they're doing is they're looking at potentially getting an extra $30 a week in rent, but they're never going to get any capital growth on the property. Or it may take a very long time for that property to grow in value. And it can be difficult for investors to build a portfolio that way. Whereas, when I'm buying properties, I want to buy a property that's going to grow in value by $50,000 or $100,000 a year, which is significantly more than $30 a week. Right? If we look at $30 a week, averaged over a 12-month period, we might make a couple of $1,000s at best. Whereas the capital growth is really the juicy part of the sandwich, really. And, I want to make sure that I get both. And it's about managing the portfolio growth so that you've got a good mix of capital growth and cash flow. If you're focusing on just one or the other, those things can affect your portfolio growth over the long term.
Okay. So negative gearing allows you to reduce your overall tax bill. However, you'll need to be able to cover the shortfall between the rental income and those outgoing costs. That's correct?
Yes.
Yep.
That's right.
And whilst a positively geared property could add to your overall income, you'll have to pay tax on that extra money.
Absolutely. If you're making a profit, you've got to pay tax. But to answer your question earlier, which I didn't quite cover off, was that can a negatively geared property become positive and vice versa? You'll find over time that if you're holding a negatively geared property, it may be negatively geared from a tax perspective in the first few years. Over time, your rents will go up, and if you've got your loans at principal and interest, you'll be reducing the loan cost every month because you're paying that loan down, and over time, your rents are going to increase. So what was once a negatively geared property that saved you tax, eventually that's going to flip over and become positively geared. It's going to put extra income in your pocket, which is going to go back into your overall income bucket. Right? The thing to consider is through that, a lot of people are not just going to get a loan once and sit on that for 25, 30 years. People don't do that. They often refinance and restructure their portfolio. They pull out equity. And so that's why it's very difficult to have a blanket rule of investing in one particular strategy or the other. And this is why it's so important that investors understand that there is no silver bullet with property investing, and that having that golden nugget or that silver bullet or whatever they're looking for, and we call it the unicorn property, and going out there and searching just for positive cash flow properties, it's a bit of a misconception that that's the best way to invest. And we always teach people to set out a plan based on their long-term goals, work out the dream, which is your goals, the date that you want to achieve those goals, and the dollars. How much money do you actually need to achieve those particular goals? And we know that those goals are going to change, but you need a starting point. And then once we've identified what that is, we work from the back end. We work from the end goal backwards. Whereas a lot of people start out, today's day one, I've got some money, let's go and buy a positively geared property because that's what I've heard is the best way to invest. But there's no long-term plan there. And so this is why we need to make sure that the property selection fits in with that long-term plan. We know that that plan's going to change over time, but by getting the right properties in the mix, we can balance a sustainable growth portfolio where you can keep buying property. Whereas if you don't have enough capital growth, you're not going to have enough equity to tap in to get more deposits. If you don't have enough cash flow in the portfolio, the banks are going to say, no, you can't afford to service any more debt. So it's getting that balance right and making sure that every single property that you purchase has a specific purpose in that property portfolio.
If you wanted to get fit or start a fitness program, you wouldn't run a marathon if you hadn't yet mastered jogging. You also wouldn't begin weight training by lifting 30-kilo dumbbells. There are, of course, multiple ways to keep fit through a variety of sports and exercise programs. However, there is a process to getting into shape and achieving peak performance. It's the same when it comes to investing in property. You need to start by doing some self-assessment of where you are now to where you'd like to be. This would be your fitness test. You have to find your team of experts who will help you along the way. These would be your trainers. And learn how other people invest, including the mistakes they've made. Only then can you start to look at how you will achieve your property investing goals. Property Fit assists you with all of this. It's the latest book from experienced property investor, entrepreneur, and founder and CEO of the Property Mentors, Luke Harris. It's the book that will guide you through the groundwork you need to cover before you start investing, exploring all the ways to invest in property by helping you find a strategy that will lead to the ultimate goal of financial freedom. Property Fit is your easy-to-read, practical book including mentor tips and mindset insights, as well as proven strategies that seasoned investors or those just starting out in property will find invaluable. Visit propertyfitbook.com.au to purchase your copy and get your property portfolio in shape for financial freedom.
Is positive and negative gearing, are they considered strategies?
Not strategies as such.
Okay.
They're essentially buzzwords. Quite popular buzzwords, I must say, and I'll probably upset a few people by saying that.
Yes.
But as I said before, you can't drive past, you can't drive down the street and pick a positively geared property. You can't drive down the street and pick a negatively geared property. You can't look at an investor and go, well, they're definitely negative gearing and they're definitely positive gearing. The trick here is that I can make any property in my portfolio positively geared at any point in time. Do you know how I do that? I either reduce debt, put $100,000 into the property, pay off the loan by $100,000, all of a sudden it becomes positive cash flow. If I want to go and buy a property with a 50% loan to value ratio as opposed to 80 or 90%, surprise, surprise, because my loan is so low, the rent is going to be higher than the mortgage payment and it becomes positively geared. Whereas if I get a loan at 90% on that property, I've got a higher interest expense every month.
Yeah.
Because I've leveraged at a higher amount, my costs are higher. And because my costs are higher, the rent doesn't cover it and it becomes negatively geared from a tax perspective. So it's not about the property, it's about the tax treatment of that property, and it's a financial situation. So again, putting more money into the property is going to potentially make that cash flow situation different to an investor that puts a smaller amount of money into the property.
I just quickly want to go back for a second. You touched on Augur Investor before. Can you just tell me a little bit more about that and how it works?
Yeah, absolutely. So whenever we're doing forecasting for our members and we're looking at buying properties for ourselves, we always want to make sure that we're not just plugging some data into a spreadsheet. We want to make sure that we're doing proper forecasting and using proper tools to actually do that. So we use a website called augurinvestor.com.au, and that particular website allows us to plug in all of the investors' details, including their financial situation, their deposits, what interest rate they're going to get, their income and expenses, all of those, all the tax situation, everything goes in there for the actual investor. And then what we do is we can plug in through Augur the property details. And this is what allows us to compare properties side by side by looking at the numbers. And this is why we can't look at the photo of the property and decide whether it's positively or negatively geared. We have to look at the numbers on that particular property. And that's where we put in the purchase price, we put in how much deposit we're putting in, the rental income, the capital growth rate, and it allows us to actually do forecasting on not only the cash flow situation on that particular property, but also the growth rate and when we're going to get capital growth in that property. It shows us an amazing amount of detail, allowing us to forecast a particular property to give us that real insight that we need to be able to compare property A with property B versus property C. And then that way we're making informed decisions based on the numbers and not really getting that emotional connection to whether we like the floor plan or the landscaping or anything like that. So it really allows us to put our investor hat on and make sure that we're looking at the raw data on that property and how it applies to your own personal tax situation.
So every time you've spoken about an area or a property having potential growth, and when you've spoken about going off the numbers, this is how we're able to measure and essentially forecast these numbers.
Yeah, that's right. And the thing is with Augur Investor, it allows us to actually give a number of different scenarios. So if we have a forecasted capital growth rate on a particular area, what we can do is we can say, well, it might be 6% capital growth, but what if it's only 4%? And the rental income on that property might be $400 a week, but what if it drops down to $350? And we can provide all of those what-if scenarios to work out whether a particular property is going to give us a best case scenario, a worst case scenario, or somewhere in the middle, maybe a likely scenario. And so whenever we're running numbers on a particular property, I always like to do a likely scenario. I always know what the interest rates are going to be for the next few years within a little bit here and there. We always add a little bit of a buffer in place there. I know what my income's going to be for the next few years. But there's things that I don't know, such as the rental market, for example. The rents could drop. But we always do a likely scenario. We know what it's going to rent for in today's market. And then we also do what I call a worst case scenario. What if that $400 a week property drops down to $300? What if interest rates go up from 3.5% up to 6%? What happens if my income drops by $50,000? All of these scenarios can be put in there. And what that gives you is it gives you two scenarios to look at. One is a likely scenario that's probably going to happen within a certain tolerance. And then there's a worst case scenario. And then you look at the gap between the two. And I say, well, if I can afford the likely scenario and that's going to work out for me, and there's a worst case scenario that's absolute doomsday scenario, somewhere in the middle is what may happen, right? And if I can still tolerate the figures on that property as a worst case scenario, knowing that the likely scenario is the one that's probably going to play out, then I can make an informed decision because it's probably not going to get much worse than the worst case scenario.
Yeah.
And if you want to be a little bit playful, you can always look at a best case scenario, right? And we always want to be relatively conservative with our forecasting, but sometimes it's a little bit of fun to say, well, what if it grows at 8% or 9%? What if the rental income grows at a particular rate? And that way you can look at what your best case scenario might be. You don't want to make your decisions based on that alone, but the reporting in there is very helpful and allows people to make an informed decision. And we rely on that as a forecasting tool for our members.
Yeah, that's amazing. And so helpful that we're able to see or at least have a pretty good idea of what those possibilities look like.
Yes, that's right.
Well, if you would like to get in contact or know any more about us here at The Property Mentors, you can check out our website, thepropertymentors.com.au. You can also follow and connect with us on any of our socials, which are always linked in our show notes, along with a link to our blog. Please make sure to share, like, or leave a rating. We really appreciate that as it helps us reach more people and help them on their investing journeys. If you would like to expand your investing knowledge and get your hands on Luke's latest book, Property Fit, you can visit propertyfitbook.com.au. And lastly, super exciting, a part of being at TPM is that we like to celebrate our successes, and so Luke, myself and the rest of the team are off on a holiday to Cairns next week for the week. This will be my first holiday with the team, and I can tell you right now that I am very bloody excited about the activities we've got planned.
Absolutely, looking forward to some sunny weather up there, and looking forward to seeing the Melbourne team up in sunny Queensland with us.
Yep, I cannot wait. And although we'll be on holiday, we'll still be back in your ears next week. So thank you for listening, and Luke, as always, thank you for your time.
Thanks, Phoebe. Have a great week ahead.